Welcome back. So now we learned concepts from chapter 2. Now we're going to apply it to chapter 3, which is understanding transactions. Okay. So first, let's actually talk about the chart of accounts. The chart of accounts is a systematic way to be able to organize your ideas and thoughts into specific accounts. So as I've mentioned before, right, we talked about what these accounts are. Now, today I'm talking about what they do for recording your transactions. So in this case, right, as you can see, it's a listed a bunch of accounts in a particular order, okay? Depending if you prefer to use account numbers, then you would find some kind of method to organize it how you think is fit for you, okay? Whether it's like some kind of 5-number sequence, or it could be a mix of numbers and letters and numbers. But in this case, it's standard if it's just, 10,000s are your assets, 20,000s are your liabilities, and so on and so forth, okay? Now, what you're going to notice is the chart of accounts is created by the accountant, okay? This is not the bookkeeper's job, right? We talked about the bookkeeper versus the accountant. The accountant is going to create this master chart of accounts so then they can give to the bookkeeper, and the bookkeeper is going to use this chart of accounts to journalize their transactions, okay, to record their transactions. Now, as you can see, this is typically in order by account type. All right, so we have your assets first, your liabilities next, your equity third, then your revenues, then your expenses are going to be very last, okay? So again, you need to have a chart of accounts created beforehand before you can actually properly record a transaction, okay? The general journal. So this is what it means to journalize a transaction. We put it in a book called a general journal. So again, it's a book where you record all your business transactions. Straightforward. Now, how do I organize it? How do I start? Now, in this case, as you can see, a lot of arrows everywhere, but that's okay. Let's start with the first step here is you're going to notice that every transaction that you do, it is in order based on date, okay? That means when you journalize your transaction, you're doing it on a day-to-day basis. It is going to be in chronological order, okay? That way, you don't just go jump from today's date to yesterday's date to the day before, right? It's a journal, right? You finish one page, you just flip it over and start the next page. Same idea here. It's in chronological order, okay? Second rule of thumb is going to be determining how we use our accounts and put them into our description, okay? So in this case, right, what the rule of thumb here is your debit accounts are always going to come first, okay? And then your credit accounts are going to come afterwards or last, okay? Now, usually that rule of thumb, okay, well, in this case, how do I know my debit accounts? How do I know my accounts are going to be debited? This is where you have to look at your transaction, understand it, analyze it, sort it ahead of time, and then properly journalize it. But the great thing with technology is we have the abilities to, delete, backspace, type over, okay? So in this case, we are learning this on a slow process. No one's going to ask you to be perfection for journalizing right off the bat, okay? But the rule of thumb is you're generally going to put your debits first, and they are always going to be left aligned, okay? Your credits, on the other hand, are always going to be indented, okay? This is so then when you look at your journal transaction, you can immediately recognize, okay, boom, I can see my debits clearly and I can see my credits very clearly, okay? Now again, this is where the whole rule of your debits being on the left side and your credits being on the right side is because exactly in your journal, it's going to appear like that in the table. You have your date, your description, your post reference, your debit column, and then your credit column. So that's why we refer our debits as our left side, and we refer our credits as the right side, because the way that we place our numbers, okay? But in this case, right, let's go ahead and proceed to the next column, which is your post reference. Your post reference, where does this number come from? This number actually comes from if you use your chart of accounts, right? If you use account numbers, that will typically be there. So again, my checking is 10100, so it is right here, checking 10100. Okay, so that's why it's imperative that you have your chart of accounts accessible to you at all times, because you need to carry that information into your journal. Okay, and again, so let's take a look at my transaction. The first one, I decided to buy furniture. So in this case, I'm going to debit my furniture because I bought furniture, right? I acquired an asset, okay? And I bought it for $500. So that means I'm going to debit this for $500 because that's the amount of cash I spent. Now in this case, because I also spent cash, that's an asset I had to decrease because I spent it. I'm not increasing my cash, I'm decreasing my cash flow. So in this case, I'm decreasing it by 500. And here is where that double system rule is going to come into play. Your total debits are going to equal your total credits. Here you go. 500 is equal, a 500 debit is equal to a 500 credit. Now let's take a look at the second example here, because now we have an example where we're dipping to 2 or more accounts. I did say 2 or more accounts for the double system entry. As long as this stays true, that your total debits are going to equal your total credits at the end of the day. So in this case, example number 2 says that I paid for rent. Most places always require you to either do a rent deposit. They require you to do advance payments for months in advance, right? So that's the same exact scenario here, where I am experiencing that I need to pay for the rent for the current month, and that I'm also purchasing rent for the future, okay? So in this case, that's exactly what I'm doing. I spent money, right, crediting it for $1,500, and I purchased 1 month for $500, and then 2 months I had to pay for in advance, which is $1,000. So in this case, that's exactly what I have here. Is I have my total debits equaling my total credits. Okay, and then once you've done that, you need to also add in a brief description of what that transaction was. Okay, you can just, if it's better for you to just journalize it the way you want to, just add all your accounts, right? That's fine too. But if other people are looking into your work and they don't see any messages or any descriptions that's entailed to what that transaction is, if I bought rent, right? How do I know how much rent I bought? Okay? How do I know how much? How do I know? Yeah, how do I know how many rents did I purchase, okay? I don't know, because I need to put a description saying, well, I paid for rent for 3 months, and I use check number 501, okay? Adding more details to your description makes it better for you to remember your transactions, because, again, going through the motions, especially if you're going to be journalizing transactions for a whole month, sometimes it's not easy to remember what you did yesterday. Okay, so again, having descriptions are going to help you out remember what has happened here, but it also gives detail to the transaction. And you can add as much detail as you'd like, as long as you have one criteria, okay? That is to have parentheses around your description. You can have it centered, you can have italicized. The idea here is, as long as you have parentheses around them, that is your description. So again, the description section is going to hold your account names and a brief description of what the account is in parentheses. Okay? So that is how we journalize a transaction. Okay? Any questions?
No.
Okay. Let's move on to the next section, which is transaction analysis. So these are the 7 steps of transaction analysis to help you make it a little more easier for you to understand a transaction and determine whether or not to journalize it. Okay? So the first step here is you need to recognize that a transaction has occurred, right? So for instance, right, if you purchase something for the business or if you purchase something for yourself, right? That right there, you'd be able to recognize that a transaction has happened because transference of money has occurred. You purchased something, right? You have to spend money. So that's going to be your determining factor that a transaction has occurred. Your second thing you're going to do is you're going to collect it. Then you're going to analyze it. You're going to interpret it, okay? And how do I do that? Well, we have to determine, well, did this transaction affect me as a person or did it affect the business overall, okay? So that's something that you need to do is you need to make sure you know the difference between a personal transaction and a business transaction, right? That's simple. I bought a couch for my business. Great. Then you already recognize that you had a transaction occur and you determined that it was for the means of the business. Okay? Now, once we've done that, now you're going to determine which accounts are affected when actually creating this transaction. So step 3. So in this case, this is where we're looking where we already analyzed it in step 2. Now, step 3 is determining which accounts are going to be affected. Well, in this case, I spent money to buy furniture, all right? So I'm affecting a furniture account and I'm affecting my checking account because I spent money, okay? So I determined what my accounts are and how it was affected. Now, step 4 is going to be to use the business chart of accounts, okay? I check my business chart of accounts. Your first thing should be that you have a checking account. And then again, if it's a fixed asset that you have and it specifically says furniture on it, boom, there you go. You located the accounts in the actual business chart of accounts, so they do exist. If it doesn't exist, the bookkeeper must talk to the accountant and say, hey, I need to create an account for this account because we need an account for it, okay? So again, if for any reasons that you need to adjust the chart of accounts as the accountant, you can do so, all right? So once you've done so, then the next step is to use the debit and credit system, okay? So determining which accounts are debited and which accounts are credited. So as I've mentioned before, right, this is where the accounting model is going to come into play, all right? Once we get at the accounting model, right, we're going to use that to understand what did we do. In this case, I purchased furniture. I acquired an asset, a fixed asset. So that means I'm going to increase my assets, okay? So that means I'm going to debit my furniture account, okay? But in order for me to acquire my furniture, I had to spend money, right? So that's why in this case, money is considered an asset because I own the money. But in this case, because I'm spending the money, I'm decreasing my asset. There you go. Now I determine my 2 accounts and I determine how I'm going to use a debit credit system. So I'm going to debit my furniture account and I'm going to credit my cash account. Okay? And then number 6 is you're going to determine which book that you're going to record this journal transaction in. So in this case, right, when you're looking in a real business, they're going to have multiple books. One for sales, one for purchasing, one for payroll, okay? They're not going to have just one huge book. In this case, for this class, I'm only going to teach you one book, and that one book is called the General Journal, right? It's not the General Journal of Payroll, it's not the General Journal of Sales, or the General Journal of Inventory. That journal is going to hold all the transactions, okay? But when you do go to a company, they'll tell you which book that you need to put it in, okay? And then last but not least, right, now that you determine which book that you have, you're going to do it, right? Just like the Nike logo, right? Just do it. Journalize the transaction in the book, okay? All right? And we'll take more looks at examples when we do the exercise, okay? Right? So what happens when we incorrectly enter in a journal? Okay? Well, for the sake of this class, okay, because you guys are students, I'm gonna let you guys make all the mistakes that you can, because again, that's what school is for. It's for you to learn, make mistakes, and learn from your mistakes, okay? Now, in this case here, when we are looking in the professional realm, making mistakes is a very huge deal, okay? Especially when you are working for a different company. You make one minor mistake, you need to fix it, okay? You cannot scrap it off, you cannot delete it, you cannot erase it. If you're doing this by manual, you cannot scratch it out. In essence, you cannot do that because in the IRS eyes, you're trying to do a fraudulent charge, okay? As, you know, really strict as it is, that's just the rules of the government, okay? You cannot erase, undo any transactions that are already recorded. So what you have to do in this case is you would have to fix it by entering a correcting entry. So in this case, there are two ways that you can correct an entry, right? You can use the reverse and reentry, or you can use the error cancellation, okay? The reverse and reentry is straightforward. What you're going to do is you're going to reverse the transaction, and then you're going to enter in another journal with the correct amount. This is the safest way to do it because, again, it allows you to backtrack your transaction, undo the transaction, right, physically, and then it allows you to re-enter it again in with the correct amount. Error cancellation is only for more avid users or more people who have more experience in bookkeeping, because the way that we have to understand is that you are only going to create one journal and only. And this journal is going to determine what the difference is between the mistake and the corrected entry. And what you're going to do is you're going to determine which account is under or which account is over. Okay? So in that case, right, once you determine that, then you just correct the entry by putting the difference in that correct account. Now you have to be very careful because sometimes it can be very confusing and you'll end up entering in the wrong entry. And then you're going to have to go back because now you made two errors on the same entry. Okay, so it's going to be a lot harder if you don't understand the very basis of the concept of journalizing just yet. So the recommendation is to use the reverse and reentry. It's much safer. But I am going to show you the two because, again, if you find the error cancellation much more easier, then you're free to do it. Now, you can only choose one or the other. You cannot put both of them in there, okay? Because then you're going to correct an error just to create an error that you have to recorrect again. So in this case, you can only choose one of the two methods, okay? So let's go ahead and talk about the first one, which is going to be the reverse and reentry. So in this case, right, for example, here on September 15, okay, we end up purchasing office supplies with cash, okay, for the total amount of $65, okay? However, with sales tax included. However, you recorded it in your journal as 56 opposed to 65. Okay, so now we need to correct this journal entry. Okay, so in this case, when we use the reverse and re-entry, the best way to understand this is think of it in real life. Okay, I bought office supplies, right? It's supposed to be for 65, but I recorded it as 56, okay? So that means I have it in my books at 56. So in order for me to reverse the transaction, I need to go back to the store and refund it, okay? So I'm going to do that by saying I should get my cash back and I should be returning the office supplies for the $56, okay? And then what I'm going to do is I'm going to buy it back and record the office supplies and me spending the cash for 65. Okay? So this is using a real life scenario, so it makes it easier for you to understand how I do the reverse and reentry, right? In my books, I recorded it wrong. So what do I have to do? I have to reverse my transaction, and then I need to enter it in for the correct amount. Okay? Any questions here?
No.
Okay. So then what's the difference between that and error cancellation? So in this case, right, my error cancellation is a little difficult. It can be difficult, but again, if you choose the error cancellation, we talked about this, right? It's just one journal entry, and what you need to do is you need to determine the difference between your mistake and what the correct entry is. So in this case, right, in my books, I have $56 worth of supplies and I spent $56, okay? Now, what do I have to do as well? What is the difference from that between the correct amount? In this case, it should be 65. So in this case, 65 minus 56 means I am short $9 somewhere, okay? Now, I need to think about it. Am I short in supplies or am I over in supplies? In this case, right now, I only have $56 worth in my supplies. It needs to be 65. So in this case, that means I need to increase my supplies by $9. So then now I actually have $65 worth of supplies. And same thing with cash, right? I only spent $56 when in reality I spent 65. That means I am missing $9 cash. So that means I need to decrease my cash flow by $9 because I don't have that extra $9 in my pocket. It's not there. So that is the assumption that you have to think clearly about, okay? Which account is over or which account is under. So in this case, we were under for the office supplies and we were under in the cash. So I would have to debit my office supplies and credit my cash flow for the difference amount to correct it for the actual amount that it should be. So in this case, $9 is there. Okay. What are T accounts? Okay. T accounts is just a method for you to go ahead and put on the side of your journal to correctly tally up any totals if necessary. Okay. So T accounts, so if I, again, journalize a bunch of accounts with cash in it, what I can do on the side of my journal is, well, I just had sales, then I spent cash, then I spent cash again. So in this case, how do I go ahead and determine that? Well, on the side of it here, this is what I'm going to start with. I'm going to start with my beginning balance. I'm going to draw a little T, right? Left side being my debit, right side being my credit, right? And underneath that, I'm going to record, well, in this case, I have cash flow because I sold something. Boom. I've also paid for rent, $500. Boom. I also paid $65 for office supplies. Boom. So in this case, I'm going to get a total debit and a total credit. And what I'm going to do here is I'm going to find the difference between the two. So then now I know what my ending balance is. So in this case, I have 5278 for my debit side, and I have 565. So in this case, $565 on the credit. So that's going to, I'm going to take the difference between them, and it's going to give me that I should have $4,713 left in my cash account. Okay, this is unnecessary. I'm just teaching you so then you know, oh, if I'm going to be recording my journals, right? How do I know what my account balances are? Well, this is a quick way for you to determine that. Okay, but here is another book that can actually help you answer that question. And we call this the general ledger. Okay? What is your general ledger? It is exactly identical to a journal, except the difference here is you will always have a running balance in each account. So it's a list of all the accounts that exist in your chart of accounts, and at the end of every table, you're going to know what the balance is at the end of every given transaction. Okay? So for instance, right, if I started out my bank account with X amount of money, right? Here, like I mentioned, right, we had sales of $154, right? So that means that increased my cash flow by $5,278. But then I had to pay for rent, which took out $500. So then I only had $4,778 in my bank account. But then again, I spent $65 more to buy office supplies. So that means now my account balance is $4,713. So in this case, what does the general journal do? The general journal literally only journalizes your transactions on a day-to-day basis. It nowhere on there will determine what your account balance is. And that is why in the accounting cycle, what comes right after the journal is to follow up your general ledger, which is going to give you your account balance at any given time. And the best rule of thumb to keep a really good track record is to always check your checking account. Okay? It's to always make sure that all your transactions that occurred in your checking account has either cleared, is pending, okay? Again, a lot of people do they do online banking to make sure that they have enough money in their checking account. This is the same idea. So when you journalize a transaction, you're going to post it to your ledger, those exact dates. You're going to put whether you debit or credit the account, and that's going to determine, did you increase your cash flow or did you decrease your cash flow, right? And you're going to have a running balance at all times. Okay, so that's the difference between the journal and the ledger. The journal is day-to-day transactions. The ledger is the same thing, except you have your account balances. Okay? Are there any questions here? Okay. Course review. We learned about what the chart of accounts is and what it does when you are going to be journalizing, okay? This right here is an example of how a journal should look like, with the date, the account names, account numbers if you have any, okay? And of course, you have your equal debits equaling your equal total credits, okay? I briefly went over what a T account does. It's not necessary for you to learn, but in case that you just need to make a quick overview of what you have, then in your journal, you can do so and use T accounts. But the main purpose, if you want account balances, is to refer to your general ledger. So the difference between the journal and the ledger, again, the journal only does day-to-day transactions, okay? Your ledger records the actual account balances, Okay. So, and then we also taught you that how to correct your entries. Okay, you have two methods, right? The reverse and reentry and the error cancellation. Okay. So that was chapter 3. Let's go ahead and go over the exercises. Okay. So, right, first question is going to be, what is the chart of accounts?
It is created by the accountant.
Yes, but what is it?
A record of transactions,
Not a record of transactions.
the balances.
Not the balances.
Like checking account and loan equity.
Okay, you gave examples of accounts, but what is the chart of accounts? What does it do for the
Oh, it's all
bookkeeper?
list of the account.
Good. A list of all the accounts. Good. Okay. For a business transaction.
Mhm.
Good. Right? And yes, it is created by the accountant. Number 2. Okay. What is a general journal?
A book, a book where daily business.
Business transactions are recorded.
Good. Good. Okay. Number 3. Okay. What is the general ledger?
Running account balances.
Yes. Good. So it is also another book with business transactions with, okay, along with their account balances. Okay. Number 4, what are the 7 steps of transaction analysis? What's the first step?
Uh, Recognize that a transaction event
Mm-hmm.
even has occurred and what source documents such as sale invoice from the supplies.
Good.
Yes.
Okay. Number 2, what's step 2?
Understand how the transaction
Good.
affect the business and whether it's need to be recorded in the formal bookkeeping record.
Okay. Number step 3.
Mm, okay, can I say it or somebody want to say it?
I don't care.
Okay.
Whoever wants to.
Determine what accounts are affected.
Determine which accounts are affected. Determine which accounts are affected. What else?
Whether the transaction increases or decreases.
Okay. What's step 4?
Okay. Use the business chart of account to determine the account number that respond these accounts.
Okay. What's step 5?
Use the debit and credit rules to determine if the accounts are debit or credit.
Good. Step 6.
Determine what journal should be used to record the transaction.
Good. Which journal to use? And what's step 7?
Do it.
Do it.
Record the transaction.
Do it. Okay. Record transaction. Good. Okay. Number 5. What is the general journal recorded in terms of time? Or sorry, how is the journal recorded?
If you make mistake on recording transaction,
No.
cannot.
In this case, I'm saying how is the general journal recorded in terms of time?
In the books of the business?
In terms of time.
Oh. Time.
Like, when do you record a transaction?
When you do a transaction,
Okay.
Oh, okay.
like
You
the
must
date and time.
you must do one of the these method to correct the error.
I'm not talking about correcting errors right now. I'm talking about how do you journalize your transactions in terms of time? Is there a
Right away.
specific order that I need to put in my journals?
First is it's debits and then expenses.
Debits and credits, but in this case, in terms of time, how does debits and credits affect time? Like, when do I record it?
As soon as
Right
you make
away.
a transaction.
Say that again, Shannon.
As soon as you make a transaction,
As soon as you make a transaction, when?
It's a journal entry.
When? I'm talking about when. What time? Okay, I'll just give you the answer. So in terms of time, meaning it needs to be in chronological order, meaning when the day it happens, it needs to be in order based on time. You cannot write a journal that happened today and then write a journal that happened yesterday and then write a journal that happened a month ago. You need to be in chronological order. It has
like immediately or in a day.
they usually journalize it within the day. Okay, there's unless you have the application where you can travel with the phone and be able to record your transactions on the go, which you can do in QuickBooks, right? We talk about that in QuickBooks. But in this case, right, if you don't have that capability, then when do you actually record it? You record it at the end of the day. But at the end of the day, every single source document's going to be time stamped. That's your key word there, is that when do you record it? You record it when it happens. But what kind of order does it have to be? In chronological order, meaning it's definitely time sensitive. Chronological order. Okay? Meaning it has to be in the sequence by the date. So if I put something that's February 1st, I better not put anything January 10 right under it. It has to be January 10, January 30th, February 1st. Okay? So it has to be in chronological order. So that's in reference in terms of time. Okay? Number 6, okay? When recording the general journal, what goes first?
Debit.
Your debit accounts are always going to go first. Good. Okay. All right. At the end of the journalizing, what must be true?
all information must be recorded.
Okay. But this is talking about at the end of journalizing, right? What statement must hold true? How can I ensure the accuracy of my accounting?
Balancing.
Balancing what?
The numbers. The money.
Okay. In terms of
Transactions.
how are you transferring the money? How are you balancing it? What are you balancing? You said the balancing the money. Okay, but how did you record the money in the first place?
Credit?
Yes, you need to balance that your total debits equal your total credits. Okay. All right, number 8, what are the 2 methods of correcting journal entries?
Reverse and reentry.
Reverse and reentry, and what's the second one?
Error cancellation.
Good. All right. Now, question number 9. I'm going to give you a bunch of scenarios right here, okay? And what we're going to do is we're going to use the transaction analysis. We're going to use our chart of accounts, which is right here, right? It's part of the transaction analysis. And we're going to determine how are we going to properly journalize our transaction, okay? So here's your chart of accounts. Yes.
What is the second form again?
Error cancellation.
Error cancellation. Okay, thank you.
Okay. So in this case, right, the exercise here is going to be, here's your chart of accounts. I'm going to take a transaction, use the 7 steps of transaction analysis to determine how I'm going to journalize my transaction. So here's your chart of accounts. Now in this case, right, let's take a look at our very first example, okay? January 1st, you have the date, okay? You paid rent for $500 cash, okay? So in this case, step 1, a transaction has occurred, right? I paid rent. Does that affect my business? Yes, it does. Maybe I need to pay for the rent facility so I can open up my store. Step 2. Step 3, determine what accounts are affected. Well, in this case, I paid for rent, so I'm assuming I need to have a rent account to have. And I also used cash. So therefore, my cash account must be affected. So let's go ahead and step 4, use the chart of accounts. In this case, do I have a rent account? Yes, I do. Rent expense, account number 660. Do I have a cash account? Yes, I do. Account number 100. Okay? So then step 5 says use and determine the debit and credit system. Well, in this case, I paid for rent, okay? And I used cash. So in this case, right, I spent money to pay for rent. So in this case, I increased my expenses because I spent money to operate my business. So in this case, I spent money for rent. So that means I must increase my rent expense by $500. And because I used cash, am I increasing my cash or decreasing my cash? I spent it. So I'm going to decrease my cash. So that's going to tell me I have to credit my cash account for $500, right? Step 6, we already know what journal we're going to be putting it in. Step 7 is now actually doing it, okay? So in this case, here is your journal. How do I properly journalize my transaction? In this case, well, what was the date that I had this transaction? It occurred on January 1st, right? January 1st, okay? Rule of thumb here is my debits go first, my credits go last. So in this case, we already determined I'm going to be debiting my rent expense, okay? And I'm going to be crediting, which if for knowing what the difference between a debit and credit is, my credit account is always going to be indented and it's going to be for cash. Okay? And I know what those account numbers are because I used my chart of accounts. My rent expense account was 660. Okay? My cash account was 100. Okay? Now, for how much money did I spend in order to pay for rent? In this case, my scenario says I paid $500, so therefore I bought $500 worth of rent. Okay? If you want to practice your description here, you can too, saying I paid for January's month of rent. Okay? But for this case, I'm not going to have you practice the description because we'll get there eventually. But in this case, I just want to make sure you're able to just get the basics of the journalizing down. Okay? So that was the very first example. So let's go ahead and try to do it on our own together over here, okay? So then on January 5th, okay, you end up purchasing inventory. You purchase 100 items for $1 each with cash. Okay? So go ahead. Okay, so in this case, we're buying inventory for the business. Okay? So let's go ahead and determine what accounts are going to be affected. So in this case, what accounts are affected?
410.
410, which is sales. In this case, did I sell something or am I buying something?
Buying.
We're buying, so that has nothing to do with sales. 110, which is supplies. Am I buying supplies? What am I purchasing?
Yes, supplies, yes.
Okay, let's read this again. On January 5th,
Inventory.
I purchased inventory. So in this case, what account am I going to be affecting?
150.
150. I'm buying inventory, okay? How did I buy my inventory? How did I buy my inventory?
It says you purchased it with cash, 100 items, each one cost $1.
Okay, so how did I pay for these items?
Cash.
I paid cash. In this case, I'm affecting my cash account and I'm going to be affecting my inventory account, okay? So, now that we determined that, we use the chart of accounts and we use the debit credit system. So, in this case, how am I going to be affecting my items? Am I increasing my inventory or decreasing my inventory?
Increasing.
So, am I increasing my asset or decreasing my asset?
Increasing.
So, are you going to use a debit or a credit?
Debit.
You're going to use a debit for inventory, okay? Second question is cash. Did I increase my cash or did I decrease my cash?
Decrease.
I spent it, right? So I'm decreasing it. Now, that's an asset. So am I increasing my asset or decreasing my asset?
Decreasing.
Decreasing. So am I going to use a debit or a credit?
Credit.
We're going to credit my cash account, okay? So let's go ahead and journalize it in our journal, okay? So the date that it happened was January 5th, okay? Now, since we determined my debit is going to be inventory, right? And my credit is going to be cash, right? Which is account number 150 and 100. Now, in this case, how much money did I spend?
100.
$100 because I purchased 100 toys, or in this case items, $1 each. So in grand total, I spent $100. Okay, and that's where you can make your note here saying that you purchased 100 items at $1 each. Okay, and we'll practice descriptions in chapter 5. Okay, so let's see what the next situation is. So the next scenario says that on January 8th, okay, I purchased a machine for $750 cash. Okay, so let's determine which accounts are affected. Okay, so I bought a machine.
600.
600. Cost of goods sold. I bought a machine.
Equipment, 160.
It's equipment, correct, 160 because I bought a machine. Now in this case, if I bought a machine, that means I acquired an asset. So I increased it. So I'm going to be debiting my account, right, for the equipment account. Now, how did I pay for it?
Cash.
I paid it with cash. So in this case, am I increasing or decreasing my cash flow?
Decreasing.
Decreasing. So right there, right off the bat, you already know it's going to be a credit. So let's go ahead and journalize this. On January 8th, okay, right, we already established that we're acquiring equipment. So that means we're going to increase our assets. And because we spent money, we're going to decrease our cash. So 160 and 100. So in this case, how much money did I spend to buy this equipment?
750.
$750. Okay. All right. Let's see what the next transaction is. Okay. Then January 10, I end up purchasing supplies for $56 on an account. Okay. So here's a new terminology here. Okay. I purchased supplies on an account.
110.
Okay, 110, right? I bought supplies, right? Am I increasing my assets or decreasing them?
Increasing.
Increasing because I acquired some supplies. Now here's the weird terminology. What does it mean that I bought it on an account?
That you didn't use cash.
We didn't use cash, right? We owe the people money because we have an account with them and said, bill me how much I owe you, right? So in this case, I owe money to a vendor. Now, in essence, let's take a look. What liability would I be using? Right? Because I owe people money, right? I owe a vendor money, right? So which liability would I be using?
Loan?
Now, in this case, am I borrowing money from a bank? Am I borrowing money from somebody? In essence, is that what a loan does? Did I borrow money?
No.
Expense.
No, it's not an expense because once again, you place this on an account, meaning you owe somebody money, right?
Equity.
That's the value of your company. That has nothing to do with what you owe.
It's not
Real
equity.
equity?
It's not an equity because how does owing money affect the value of your company?
Okay, cost of the good.
Did you sell something? Okay, read it again, Gerari. You purchased supplies. How is that selling something to somebody?
Okay, revenue.
Again, you purchased supplies. How is that selling?
I thought like expenses.
No. I bought supplies on an account. I already gave you the biggest hint here is that you owe somebody money, right? What does it mean to
Right.
owe somebody?
The liability.
It's a liability. How many liabilities accounts do you see here? How many liabilities accounts do you see on the chart of accounts?
Just one.
Try again. How many liabilities accounts do you see on my chart of accounts?
Oh, two.
Oh, two.
You have two. We already established it can't be a loan, right? You didn't borrow money from somebody. You owe somebody money. So if it's not a loan, what is it going to be?
Accounts payable.
Accounts payable, okay? When you, that's one of the key words, right? If you remember chapter 2, accounts payable is when I said you owe money to vendors, right? This is a perfect example of where you're owing some supplier money, which is a vendor, right? Not a bank, not a shark loan. You owe a vendor money, okay? So in this case, accounts payable. Now, are you increasing your liabilities or are you decreasing your liabilities?
Increasing.
You're increasing. So therefore, are you going to debit or are you going to credit your account?
Debit.
Let's try again.
Credit.
We're increasing our liabilities, right?
Debit.
We're going to increase our liabilities, right?
Oh, credit.
Yes, we're going to credit our account. So there you go. We have our debit account being supplies and our credit account being accounts payable. Okay, for January 10, I think. Let's double check. January 10, you purchase supplies, okay? So purchase supplies, okay? And you placed it on an account, so you have an accounts payable, okay? So in this case, supplies was 110, accounts payable is 200. Okay? Now, how much did you pay? Or how much do you owe this vendor?
56.
$56. So in this case, it's exactly what I'm going to record, $56. Okay? Next one. Okay? So here, January 12th, you had cash sales. Okay? Cash sales of 25 toys for $5 each. No sales tax. Okay? So let's take a look here. What accounts are affected? Okay? I had cash sales and I sold 25 toys. Cash, right? Did you increase your cash or did you decrease your cash?
Increase.
We increased our cash, okay? So now we know is that that's a debit, right? So then what's the second account that we're going to reference?
Asset.
No. What's the second account?
Cogs.
Not cost of goods sold. We're not looking at what it cost me to
Sales.
sell. We're looking at sales because we sold a product. Good. So in this case, it's going to be 410. Now, are we increasing our sales or are we decreasing our sales?
Increase.
Increase. So are we going to debit or credit that account?
Debit.
Try again.
Increase.
We're going to increase our sales, right? Use your accounting model. How do you
Okay.
increase a revenue account?
Credit.
You would credit it. So in this case, there you go. It's January 12th. Okay. We increased our cash flow and we increased our sales. Okay. So we increased our cash flow and we increased our sales. Now, by how much? How much did we sold? Well, in this case, I sold 25 toys for $5 each.
$125.
125, right? 5 times 25 is going to be 125. So I earned $125 from this sale. Okay? So then the next question says, well, because I sold my inventory, right? I need to adjust the inventory for the cost of the items that I sold. So in this case, I need to adjust my inventory because right now I have 100, right? But because I sold 25 of them, I need to adjust my inventory accordingly, right? But I also need to determine how much it cost me in order to sell those items. So in this case, what accounts should I be using?
Inventory.
Inventory. Did we increase our inventory or did we decrease it?
Decrease.
Decrease it, and it's an asset. So are we going to credit or debit the account?
Debit.
Try again. We're decreasing an asset, right?
I thought when we are increase, it's gonna be a credit.
It's an asset.
Mm-hmm.
Look at your accounting model. Debits increase assets, right?
Mm-hmm.
And I said we're going to decrease our inventory because we sold our items, right? We got rid of them, right?
Mm-hmm. Credit.
We're going to credit our inventory. Okay? Now, what account am I going to use to determine the cost of me selling those inventory items?
Cost of goods.
Cost of goods sold, right? In this case, I'm going to increase it because it's an expense account. Okay? So there you go. January 12th, right? We're going to increase our cost of goods sold. And we're going to decrease my inventory because I sold stuff, right? I got rid of 25 items. Now, in this case, how much is going to be the amount that I'm going to be calculating? Cost of goods sold 600. Okay?
600.
No, right here. That's the account number. So in this case, I sold 25 toys. Okay? When I purchased my toys, how much did it cost me?
125.
Okay, more specifically, how much was it per item?
No,
5.
That's what you sold it for. I'm asking you what it cost me. What did I originally buy the items at?
$1.
$1 each. And if I sold 25 of them, how much did it cost me to sell?
25.
It cost me $1 each. So therefore, $1 times 25 is going to cost me $25. Okay? That means I profited $4 per item I sold. Okay? All right. There you go. Now, last but not least, on January 15, you borrowed $5,000 from the bank. So what does that tell me? I borrowed, you got a loan. Okay? Now, what did I get out of that loan?
Liability.
It's a liability, yes, but what did I get out of that loan?
Cash.
You got cash, right? So there you go. Are you gonna increase your cash flow or decrease it?
Decrease.
Why?
Inc-
You're gonna increase it. You just got money.
Oh, okay. But in a long term, it's gonna be decrease, right?
Well, do you owe money or do you not owe money?
We own money.
We owe money. So did we increase the amount that we owe or decrease it?
Yeah, because we add. Yeah.
Yes, we add. So in this case, we are increasing our liability. How do I increase a liability?
Access. Asset.
No.
Hmm.
How, like, am I going to debit or credit?
Credit.
We're going to credit the account. So in this case, loan was $250, cash is $100. So January 15, okay, we increased our cash flow because we borrowed money, right? And because we took a loan, that means we owe money. Okay? So, how much money did I borrow?
5,000.
You borrowed $5,000. So, therefore, you owe the bank $5,000. Okay? All right, good job. All right, so again, this isn't going to be the last time we're going to be looking at transaction. From chapters 5 and all the way to chapter 13 is all about journalizing. Okay? Understanding what accounts to use, how I use the debit credit system. So that's why I said every chapter is going to build upon one another. So after chapter 3, everything from chapter 5 through 13 is going to rely heavily on chapter 3, which is to journal. Okay? All right? So let's see. Almost done, guys. All right, question number 10. Using the transaction on January 10 from above, okay, you recorded that the supplies were $56, okay? But then on January 20th, you realized that there was an error, okay? And that the supplies were actually $65, okay? Record the following correction error using both methods. So the first one is going to be the reverse and reentry. Okay? So on January 10, I recorded that I bought supplies on an account for $56. But in reality, that was wrong. It was for $65. Okay? So how do I fix this? Using the reverse and reentry. So right now it's January 20. January 10, I wrote the wrong entry. I put in that I have $56. Now, January 20th, I realized I made a mistake. Now I need to fix it.
Oh, okay.
You're going to,
Okay.
How do I use the reverse and reentry method?
the description would be accounts payable?
Accounts payable, because again, that's correct, right? I have to undo my transaction, right? In this case, I'm going to undo my accounts payable, okay? Now, what is that going to also undo as well?
The supplies,
You're going to also undo the supplies, okay? So if you remember my scenario from earlier, now that I made my mistake, I have to fix it. How do I fix it? I'm going to return the supplies, right? For what amount?
56.
$56. Good. Now that I returned it, how do I put it in again for the correct amount? I'm going to rebuy it, right? So in this case, supplies, okay? I'm going to place it back on an account.
And you're gonna put in the correct
Mm-hmm. And what's the correct amount?
65.
65. Excellent. Okay. And here, I'll go ahead and give you an example, right? Every time you do an error like this, you're going to say to correct the error on entry. Okay, wait. Okay, correct the error entry on January 10. Okay, because that was the original journal, right? Okay. Okay. Now let's practice and using the error cancellation method this time. Okay. So in this case, right, how am I going to use the error cancellation method to correct this journal? Right now, my supply says I have 56 when it needs to be 65. So how do I correct that using the error cancellation? What do I need to determine first?
The difference.
What's the difference between 65 and 56?
$10.
What's the difference between 65 and 56?
9.
$9. Good. Okay? Good. So there you go. I determined the difference. Now I need to understand which account is under and or which account is over. So in this case, am I short in my office supplies, or I'm sorry, office supplies, or am I under in my supplies?
Under.
You're under, right? Because you originally recorded 56. You need that to be 65. So in this case, am I going to increase my supplies or decrease it?
Increase.
Increase it. So in this case, I'm going to debit my supplies by $9. Okay? And of course, that means I also have to increase my liability because I owe $9 more. Okay? And again, your description has to be in parentheses to correct error entry on January 10. Okay? Any questions in regards to chapter 3?
I didn't understand the last one.
Okay, so what? Okay, where are you confused?
It's like, how do we add the $9? Just the difference between the 50 and the 65?
Mm-hmm.
Okay.
Because right now I only have $56 in my supplies account. What do I need my account to be?
Why we add the debit and credit? This is gonna be like 18, right?
What do you
We
mean
need
by
just
18?
because we add debit and credit. Why we didn't add just the credit, as in like they own us $9? I'm just confused. I don't
No,
know.
no, 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 no. If I recorded that I only had $56 worth of supplies, right?
Mhm.
But in reality, I have 65. So in this case, what's the difference between 65 and 56? $9. We already established that. So in this case, I need to get my account for supplies to be 65. But that means because I also recorded my accounts payable that I owe them $56, that's not true. I owe them 65.
So why we put it in a debit and credit?
Because we're increasing our supplies by $9, right?
Mm-hmm.
If you had a ledger account right now, my ledger account says I only have $56. I need it to be 65. So I need to add $9 more dollars. So that's why I debited my supplies account by $9 to increase my supplies account. So then now, if I'm doing this on my ledger, I now have $65.
Okay.
Same thing with the accounts payable. Right now, I say that I only owe them 56, but that's not true because I bought $65 worth of supplies. They never discounted me for it. I just recorded it wrong. Okay, because we're human, right? The five and the six, if you're on a keyboard, are right next to each other. How it's very easy to fat finger a lot of these numbers. So that's exactly what we did here, where we mixed up the numbers. So now, because I don't owe them $56, I owe them 65. So how do I make my account reflect that I owe them more money? I need to add $9 because I'm increasing my liability, right? Because right now it says I'm 56, but really I owe them 65. So that means I need to owe them $9 more. So that's why I have a debit and credit here.
Okay.
All right. Any other questions?
Watch it again.
All right. Any other questions?
No, but it is confusing. It can be confusing.
Exactly, right? I could accidentally say, no,